Welcome to Spidel's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering a Secure 2.0 Act provision that goes into effect in 2024, affecting catch-up contributions for highly compensated employees. We'll be covering this, plus all the news you need to keep your clients current, as well as new tax planning strategies at Spidel's quarterly Federal Tax Update webinar series. The next session is on July 26th, and you can register for a single session or 1 year of live updates at spidel.com under webinars. Beginning with the 2024 taxable year, catch-up contributions are required to be made to employer-provided qualified retirement plans on a Roth basis, or after tax, for employees with compensation in excess of $145,000. This compensation amount will be indexed for inflation starting in 2025. This provision of the Secure 2.0 Act affects employer-sponsored 401k, 403b, and governmental 457b plans, but the new rule does not apply to SEP or simple plans. Many of the Secure 2.0 Act retirement provisions are optional, like the provision that allows employers to offer their matching contributions on a Roth basis, or the provision that allows for the creation of new emergency savings accounts. But the provision requiring highly compensated employees to make catch-up contributions on a Roth basis is a mandatory provision. This means that an employer who only offers a traditional 401k without a Roth option cannot accept catch-up contributions from their highly compensated employees. For the 2023 taxable year, the inflation-adjusted catch-up contribution for taxpayers age 50 and older is $7,500. The 2024 contribution amount has not yet been announced. Employers who don't currently offer a Roth option in their 401k, 403b, or 457b plans, and who want to ensure their qualified, highly compensated employees can still make catch-up contributions in 2024, will have to take action now to amend their plan documents to allow for Roth contributions. For purposes of the mandatory Roth catch-up contributions, the term highly compensated employee does not have the ordinary meaning given to that term under IRC Section 414Q. Instead, a highly compensated employee for purposes of the mandatory Roth catch-up contribution is defined as an employee whose wages for the preceding calendar year from the employer sponsoring the plan exceed $145,000. This definition gives rise to a couple of interesting observations. First, highly compensated employees for purposes of the Roth catch-up contributions are based strictly on the amount of wages paid in the prior calendar year. So, unlike IRC Section 414Q, a 5% owner of the business is not automatically deemed to be a highly compensated employee. Second, high earners who are new employees will get a free pass in their first year because only wages paid by the employer sponsoring the plan are counted toward the $145,000 wage limitation. If you're looking for a deep dive into partnership and S-corporation issues, sign up for Spidel's 2023 Summer Tax webinar. We'll be covering basis calculations and adjustments, making an S election, proportionate distribution rules, and how to prevent entity owners from being liable for entity-level taxes, and more. You can register at spidel.com under webinars. That's all for this week. Join us next time for another episode of Spidel's Federal Tax Minute.